let's go to the big elephant in the room, as always, and it's been there for a long time, which is the big Moody's downgrade that we seem to face continuously. And for sure, if it doesn't happen in March, we'll just all push it out to November. But as everyone seems to agree, it is inevitable. Marie, if we think about Moody's downgrade, do you expect quite an aggressive response to that from, let's say, the currency, the markets? And once it happens, is it fair to say that South Africa is actually a top-rated sub-IG country for what we have to work with right now? And are you worried about S&P and Fitch having negative outlooks?
Okay, so, I mean, I think we're probably all in agreement is really is a matter of timing. And you would expect there to be a market response. I do think that both the currency and it depends on the timing of the adjustment of various funds that are benchmarked. That said, I would expect there then, and it was the point that I think Michael made about the size of the South African asset markets or financial markets. We have such a large pool of domestic assets that would then reassess value and maybe to Wayne's point as well. And I think that there would be a retracement. It probably wouldn't be a retracement back to previous levels or previous averages, but we would expect a retracement. I do think that does put us potentially at longer term risk of further downgrade. So I think that S&P and Fitch are more likely to continue downgrading. I think the road to upgrades from any one of those three ratings agencies is contingent on reassurances that we are simply politically and fiscally unable to make at this point. So I do think that we are definitely at risk of a deterioration in the path of ratings. That said, and it does have asset market implications. That said, though, from an economic perspective, and I don't know if you feel the same, but I'd quite like this downgrade just to happen so that we can refocus on the task at hand, right? There's so much discussion about what we're going to do, try and avoid a rating downgrade, and the focus of some of the policymakers really is on this. Actually, I think the market's priced. I think we know that we're no longer there, but what we need to do is focus on some of the reforms needed to avoid the other downgrades deeper into junk territory, whether it's the ease of doing business scores, whether it's the stabilization of the EAF, whether it's sorting out domestic institutions, and in general gearing ourselves to a trajectory of better quality, higher, more inclusive growth. I think that's where the focus needs to lie. So,
and you can still do that after a downgrade.
And you can do that after a downgrade, because we know that globally there are countries that have done that after a downgrade, right? And Brazil, which came up as an example in terms of its pension reform in earlier discussion, which has a policy that's vastly different to ours, but has in fact managed to deliver political reform for their pension policy. It's all backloaded, but is looking at the potential for an upgrade now. It's deeper in negative territory than we are, or in junk territory than we are, but looking for an upgrade now on the basis of that reform agenda post all those downgrades.
Yeah, so there is some light at the end of the tunnel.
Oh, sure.
So I want to bring, Wayne mentioned the SARB and cutting interest rates, inflation being low. So Mamokete, when it comes to monetary policy, and we always know that there's, a nice configuration between monetary policy and fiscal policy. And typically, in theory, where fiscal policy currently is, one would not expect a SARB to be dovish or going on any kind of rate cutting spree. What are your thoughts around inflation and what the SARB is likely to do?
So the monetary policy story has been another one that's become very complicated. All of these things sort of became all very complicated at the same time. So under normal circumstances, it would be inflation is low, the outlook for inflation is low, you've revised your outlook for GDP, you've revised your outlook for inflation is within the target range, 1 + 1, the SARB's going to cut. But I think the complexities of having to deal with what was a very quick deterioration in some respects in the fiscal policy since 2016 made it very difficult for the SARB to cut rates post 2016. So it's been it feels like it's been forever, but it's really been over the past 2 to 3 years. And as a consequence of that, so the SARB was sitting there saying, well, there's this risk. Before it was political risk, and then it was Moody's. Moody's became part of the political risk, and it created this risk to the inflation outlook. So you had an inflation outlook, but you had this risk, and I think it biased the SARB towards being more hawkish than they otherwise would have been. And as a consequence, you have inflation that actually has also come in below expectations consistently. So growth has been below expectations, inflation below expectations, and the SARB that felt like it was more reluctant to cut than what would have otherwise been justified. So, now you're sitting here and you have inflation expectations just north of 5%. That's your very long-term inflation expectations. Inflation forecast for the year, for most forecasters sitting in the midpoint of the target range or below. And essentially, it feels like the SARB has literally been pulled kicking and screaming onto a path of easing. So their inclination, I think, is to be a little bit more hawkish because they still see the risks as positive for a long-term inflation outlook. So in terms of what the SARB is going to do, my sense would be that as long as inflation expectations remain where they are, and you still need to get past Moody's there's a real chance that they'll cut again. But nobody wants to put it in as a base case scenario. And they will do that because I'm with Marie and with Wayne that if you look at asset prices, the downgrade is pretty much discounted. If you have pressure coming through on the currency, it's probably going to be transitory. And that the transmission from currency to long-term inflation is probably not going to be there. And as a consequence, the inflation outlook is probably going to remain as is. And core inflation remains very, very low. And that's because demand remains quite low. So beyond the short term, so if you get a downgrade by Moody's in March, chances are, well, they might look at the rand over the next quarter and not do anything. But come the second half of the year, I think, and it's not necessarily a view that's shared with everybody, that come the second half of the year, the SARB will be cutting again. If Moody's doesn't downgrade now in March, they'll cut in May, no doubt, because the environment does call for it. So I think if you look at where we are, the argument has been with the SARB, well, they've said, well, if you cut, it's not really going to make a difference for GDP, right? And my answer to that, is like, well, you've never done it before, so do it, let's see. Because all of these things are assumptions, and the environment is the environment. You can never really know exactly how things are going to pan out. So my sense would be that they've been a lot more risk averse than anything else.
And Wayne, you think rate cuts would help?
Look, anything helps. It's better than rates going up. And surprising enough, contrary to all, I suppose, common knowledge, South Africans themselves are not massively overgeared. No. I mean, the debt to GDP ratios for its ordinary citizens, your capital, your interest repayment as a percentage of disposable income, it's not as low as what it was in 2001, 2002, but it's below average. So as individuals, maybe because of all the uncertainty, we haven't overgeared. So there is the possibility with lower interest rates and a more stable environment and a more stable government and more stable policies, and there's many ifs. People actually can go out and borrow. I mean, I work for First National Bank. We haven't grown advances double digit since 2006. We've been growing low single digits. So there's no actual credit demand out there. You can look at housing prices. There's no demand. As I said earlier on, you get a few interest rate cuts. You go junk status, but the rand doesn't collapse. The higher platinum price and palladium price is all helping. You can turn it into a more positive outlook. It doesn't have to be great. It's just going to be better than what we have had the last 10 years.
Gina, to touch on something that Wayne's brought up a couple of times, but it's important for growth and it's important for asset markets, is this issue of confidence. And Wayne was saying, about how the bottom always feels terrible. I think we all go home and feel weighed upon for various reasons. Haroon talked about the missing middle and severe income constraint. Unemployment is extremely high. People are concerned about the world that they're living in. Confidence is a huge issue. And the small incremental changes that a credible budget that says government is making a fiscal effort, despite the constraints that Michael brought up, because there's not all that much they can do in terms of delivering on wages, which we've heard about today, in terms of delivering on savings, in terms of raising taxes. We are in an extremely constrained environment. But to say we will improve on the MTBPS baseline credibly, and we are making an effort, and there is an evolution of discussion that is constructive, I think would be good for sentiment and good for markets. Similarly, for the SARB to come out and say, we recognize that there is fiscal risk. We recognize, too, that inflation is likely to be lower than we thought. We are in an economically constrained environment. We feel that the instruments that we have at our disposal are useful instruments to implement. We will provide the support that we can in this environment and ease further. Again, speaks a little bit to a consistency of policy that creates a more confident or stable environment for business to operate and for households to engage in their own business. And I think that is an incredibly important progression to make, especially in an economy that's had a structural decline in business and consumer sentiment really since 2012. And I think that would be an important delta to stabilize, to provide a platform for growth too.
And it seems like that would also be a positive for Moody's. It might just kick the can down the road, but it's for sure the type of credibility statement we need then.
It would. I mean, we obviously have to deliver on it. So I think that's the other thing, is that some of the issues that were addressed in the State of the Nation, the news about Minister Mantashe yesterday, these are all positives, but there has been, I think, an understandable breakdown in people's willingness to believe and cook into a forecast or a baseline. Some of the commitments made when they seem to not really land anywhere, and that's not just economic policy, that perhaps goes through to sort of some of the issues with the various commissions, the findings on state capture. All of these things actually need to evolve. The processes need to evolve, and they need to deliver. So I think that is a key part of rebuilding confidence. But I think it just starts with a change in momentum, and I think those two things really could help